Welcome to this explainer. If you've ever looked at your bank account and thought, I'm doing everything right on paper, so why do I still feel so stressed out about money? Well, you are in exactly the right place. Today, we're unpacking a really fascinating diagnosis of our financial behaviors. Because here's the truth, mastering finance isn't actually about math, and it's definitely not about spreadsheets. It's about diagnosing how our own minds quietly and constantly sabotage our wealth. So, why do smart people go broke? It's kind of a crazy question, right? I mean, you've read the books, you've put in the work, you're an intelligent person. But the thing is, intelligence actually hides our biases. It makes our choices feel completely rational just because they're ours. And that traps us in these really appealing fictions. Just think back to the 2021 crypto boom. We saw thousands of tokens with absolutely zero real world utility, but they had a flashy story, and incredibly smart people just abandoned the math because the dream was sold so perfectly. We buy into these comforting half-truths that feel good in the moment, instead of facing the cold, hard reality.
Morgan Housel perfectly captures why we fall into these traps when he says people do crazy things with money, but no one is really crazy. Think about it like this. Everyone has a unique backstory that acts like a lens for how they view money. So if someone graduated and entered the workforce during the brutal 2008 financial crash, they're going to carry deep emotional scars that make them inherently terrified of the stock market. But take someone else who rode the 1990s tech boom to riches, they're going to enthusiastically chase risks that other people would run away from. Two completely opposite financial decisions, but through their individual lenses, both actions seem totally rational.
Okay, so here is our roadmap for today. We're going to break down these behavioral traps through four core pillars: the myth of rationality, ego versus true wealth, the price of investing, and finally, the ultimate currency, time. Let's dive right into section one, the myth of rationality, and why spreadsheets fail in the real world. So, we all love to plan like machines, right? Optimizing every single dollar in a flawless spreadsheet. But humans aren't machines. Spreadsheets don't panic, they don't lose sleep. Aiming to be mostly reasonable is actually way more sustainable than trying to be coldly, perfectly rational, because a reasonable plan is one you can actually stick to when real life inevitably happens. Take Bill Gates. Yes, he's undeniably brilliant and hardworking, but back in the 1970s, he just happened to attend one of the only high schools in America that had a computer. That accidental advantage was a 1 in a million stroke of luck. Now, compare that to his friend Ken Devins. Kent was equally brilliant, equally obsessed with computers, but tragically, he died in a mountaineering accident before he even finished high school. That's another 1 in a million event, but this was extreme risk, not luck. Massive success or massive failure is almost always this hidden cocktail of uncontrollable luck and risk. And to put that into perspective with the stock market, historically, it delivers positive returns about 68% of the time over a single year. But stretch that out to a 20-year span, and it hits 100%. The math heavily, heavily favors long-term optimism. But here's the rub. Human emotion absolutely doesn't care about those statistics when the market suddenly plummets. When a guaranteed downturn hits, your brain is going to scream at you to abandon that perfectly rational spreadsheet and just panic sell everything. So the real threat to your money isn't bad logic. It's mistaking a temporary emotional freakout for a sound financial strategy. All right, moving on to section two, ego versus true wealth, and the hidden cost of looking rich. We so often ruin our finances chasing just a little more status, a little more validation. Look at Sam Bankman-Fried back in 2021. The guy was worth over $20 billion, one of the richest self-made billionaires in history. He had literally far more money than he could ever spend in a lifetime. But he kept pushing for more status, mixed customer funds, and lost the entire thing overnight. The concept of enough just did not compute for him. And this leads us to a really fascinating psychological quirk called the man in the car paradox. We buy the shiny, expensive things because we want people to admire us, right? But think about the last time you saw someone driving a six-figure Ferrari. Your first thought probably wasn't, wow, that driver is such a smart, successful person. Actually, scratch that. It was probably, damn, I want that car. Nobody is actually impressed with your stuff. They're just using your visible wealth as a mirror for their own desire to be liked and admired. This means we kind of have to rethink our definitions completely. Looking rich is loud. It's spending money on luxury items to show off to strangers, which, ironically, is the fastest way to have less money. Plus, it usually comes with the massive stress of huge car loans and desperately trying to keep up appearances. Being rich, though, being rich is quiet. It's the silent, unspent assets. It's the money you consciously decided not to use on a car upgrade or to flash on social media. That unspent money is what gives you flexibility, resilience, and genuine peace of mind. Ultimately, it boils down to this. Savings is literally just the gap between your ego and your income. True wealth is built by needing less ego. If your ego inflates as fast as your paycheck, like, say, a lawyer making $250,000 a year but spending every single dime of it on private schools and Porsches, your savings completely vanish. Keeping your ego in check is absolutely crucial because it gives you the margin of safety you're going to need to survive the emergencies life will inevitably throw at you. Let's hit section 3, the price of investing, and why volatility is actually a fee, not a fine. Investing is never free. But the thing is, you don't pay with cash, you pay with stress. Let's look at Netflix. Between 2002 and 2018, it saw an absolutely unbelievable 35,000% gain. But to actually get that life-changing payout, an investor had to endure watching the stock sit below its all-time high for 94% of that time. Surviving those sickening short-term drops is the literal price of admission. Market volatility isn't a fine that's punishing you for doing something wrong. It's just the everyday fee you have to pay to capture long-term gains. And here is a massive relief. You do not have to be right all the time. Since 1980, an astonishing 7% of companies drove all of the market's net gains. We call these tail events, these rare, explosive moments of progress. You can literally be wrong half the time and still make an absolute fortune as long as you survive long enough to catch just one of these rare tail events. Building wealth is mostly about defense. It's about staying in the game without wiping out. But you want to know the absolute fast track to wiping out and losing everything? It's copying someone who is playing a completely different financial game than you are. A short-term trader values speed, timing, and momentum. A long-term investor values patience, endurance, and time in the market. So if you're quietly investing for your retirement, but you start copying the moves of a friend who's day trading crypto for a quick buck, you are inheriting all of their risks without even knowing their rules. You absolutely must define your own game and tune out all the noise that doesn't fit your personal strategy. Which brings us to our final section, the ultimate currency, time, and why it is the most overlooked force in finance. $156 billion. We all know Warren Buffett is famous for his incredible wealth, but what most people totally miss is that of his roughly $160 billion net worth, more than $156 billion of it came entirely after his 65th birthday. He didn't get crazy rich by constantly chasing massive, risky short-term returns. He got rich by starting when he was 10 years old and simply staying in the game for over 80 years. That is the quiet, massive, almost unbelievable power of compounding over time. But here's the catch. Managing time actually means managing ourselves over time. Psychologists have a name for this, the end of history illusion. We can clearly see how much we've completely changed over the last 10 years. But for some reason, we assume our goals and priorities won't change at all over the next 10 years. Because we inevitably evolve, extreme, rigid 10-year financial plans almost always blow up in our faces. The smartest way to avoid future regret is actually aiming for moderation. A moderate savings rate, a moderate lifestyle, that gives you the flexibility to pivot when you inevitably change your mind down the road. And really, this brings us to why we even do all of this in the first place. As Morgan Housel beautifully puts it, the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want. Deep down, the ultimate dividend that your money pays isn't a luxury car. It's not a bigger house. It is total freedom and control over your own schedule. It's giving yourself the space to breathe and to live life entirely on your own terms. So, I'm going to leave you with this final provocative question. Have you actually defined what enough means to you? Because until you draw that line in the sand, you're just going to be stuck climbing this endless ladder of envy, where the bar for happiness just keeps getting pushed higher and higher. Step off the treadmill. Figure out your own personal finish line, fiercely protect it, and just let time do the heavy lifting. Thank you so much for joining me for this explainer, and I truly hope this helps you build not just financial wealth, but lasting peace of mind.